Two of Canada's largest gold producers just agreed to combine, and the terms reveal something the headline valuation does not. Equinox Gold and Orla Mining announced an all-share merger on May 13th, creating a company with an implied market cap of roughly $18.5 billion and projected 2026 free cash flow of $1.4 billion. At face value, that looks like routine sector consolidation, but the structure tells a different story. This is an at-market, zero-premium deal. Orla shareholders receive Equinox shares on a ratio that values Orla at exactly its current trading price. No acquisition premium, no bidding war. That kind of structure only works when both sides believe the combined entity is worth more than either individually, and when neither side can afford to pay above market to get there. Equinox itself has been repurchasing its own shares aggressively, buying back over $470 million in the first quarter alone, which signals management believes the stock is undervalued. Paying premium cash for Orla would contradict that posture. Instead, existing Equinox holders keep 67% of the combined group and absorb Orla's 3 long-life Canadian mines as an internally funded growth engine. The result shifts how capital is positioned in this name. Passive holders in Canadian gold ETFs who owned both stocks separately will now hold a single, more liquid entity with $1.4 billion in annual free cash flow, a figure that gives the combined company a buyback and dividend capacity most mid-tier miners cannot approach. The merger also pushes projected production toward 1.9 million ounces annually from North American growth projects alone, making Equinox the second-largest producer of Canadian gold. For institutional holders who require minimum market cap thresholds to build a position, that scale unlocks a new buyer class. What the merger does not resolve is the price environment that makes it necessary. Equinox's stock trades below its estimated intrinsic value even after the deal announcement, which is why management was buying back shares to begin with. The consolidation is a defensive posture dressed as a growth story, and that tension points toward the condition outside this company that is actually doing the driving. The condition driving Equinox's defensive consolidation is the same one that just forced Honda to abandon a $15 billion commitment to Canada, a macro environment where demand assumptions made 2 years ago have collapsed faster than any hedging structure can absorb. Honda Canada confirmed on Thursday that its plan to build an EV complex in Ontario is indefinitely suspended. The project would have produced 240,000 electric vehicles annually, supported by $5 billion in committed federal and provincial government funding. Every dollar of that subsidy is now stranded. The causal chain here runs through the U.S. market, not Canada. Honda's Ontario complex was designed to produce EVs primarily for U.S. consumers. U.S. EV sales fell 26% in the first quarter of 2026 year-over-year, after policymakers removed incentives and emission standards. At the same time, U.S. tariffs of 25% on the non-American content of Canadian-made vehicles added a structural cost that made Ontario production economics unworkable, even before accounting for the demand collapse. Honda is not retreating because Canada failed, it is retreating because the market it was building for no longer exists at the scale the project required. The domestic capital impact is specific. Retail and institutional holders of auto-adjacent Canadian equities, component suppliers, battery material producers, and real estate developers around the Alliston site absorbed the news through price action. Asahi Kasei, which had committed to a $1.6 billion battery materials plant in Canada, partly in anticipation of Honda's demand, confirmed it is staying the course for now. That divergence is the signal worth tracking. One supplier standing pat while the anchor customer withdraws suggests the supplier is pricing in a recovery Honda itself is not willing to bet on. The broader Canadian auto sector has now seen Ford, Stellantis, and GM reduce Ontario production over the same period, all while billions in taxpayer capital was deployed to retain and attract manufacturing. McMaster University's Greg Mordew framed the outcome directly. Canada does not make the market, Canada responds to it. If that is true, then the relevant question for Canadian portfolio holders is not whether the EV sector recovers in North America. It is whether Canada's government subsidy commitments to EV supply chain can survive intact when the anchor demand assumptions keep failing. That question has no current answer in the news pool, and it is precisely what makes the macro rate environment, the one Equinox was also responding to, the decisive variable left.
Kevin Warsh was confirmed as Federal Reserve Chair by a 54-45 Senate vote on Wednesday, the narrowest partisan margin in Fed history. Markets digested the confirmation alongside the hottest April PPI print since 2022 and a CPI reading of 3.8%. The combined result is that money markets have now fully priced out any Fed rate cut in 2026 and assign a 28% probability to a 25 basis point hike by December. That is a complete inversion of where rate ed 3 months ago. The transmission into Canadian portfolios runs through 2 channels. The first is the 10-year U.S. Treasury yield, which hit an 11-month peak this week and sits at 4.48%. Thornburg Investment Management's Christian Hoffman noted that inflation has been above target for nearly 5 years, and there is no directional signal available to reassure bondholders. The 30-year U.S. yield is at 5%. At those levels, Canadian corporate bond issuers face higher cross-border refinancing benchmarks, and Canadian real estate investment trusts, which use long-duration debt structures, face valuation compression even if the Bank of Canada holds its own rate steady. The second channel is equity valuation. Discounted cash flow models for Canadian growth companies, including the gold producers consolidating now, use U.S. Treasury yields as the risk-free rate floor. When the 10-year moves from 4% to 4.5%, future cash flow is worth less, which means the merger math Equinox used to justify its deal becomes harder to defend at current equity prices, unless gold itself holds above a specific threshold. BCA Research's Ryan Swift warned that any dovish signal from Warsh would risk losing control of the long end of the yield curve, which means the worst scenario for Canadian equity holders is not a rate hike, but a Warsh capitulation that triggers a bond sell-off larger than the one already in progress. The leaning here tilts toward yields staying elevated through at least the third quarter. Iran conflict keeps oil above $100, import price inflation runs hot, and Warsh enters with institutional credibility that makes a premature cut politically costly. The verification threshold to watch is the 10-year yield relative to 4.75%. If it crosses that level before July, the equity valuation compression in Canadian growth names will accelerate regardless of company-specific performance. If it retreats below 4.25%, the merger premium Equinox left on the table becomes a positioning opportunity for buyers who held back. What would prove this leaning wrong is a sudden ceasefire in the Middle East collapsing oil prices, which is the one variable neither Warsh nor any domestic gold producer controls. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.